the other one.
Good.
Dave's back.
We have Dave back. Good morning, good afternoon, good evening, and everyone, and welcome to the Daily Stack Macro Thursdays edition. This week, we are joined by Dave Weisberger himself, the McLaren fan, in his Bitcoin orange shirt, in addition to the weekly regular Robert Infonomics. Welcome, everyone. And if you haven't already dropped us a follow on X, we are at Daily Stack HQ. We are covering anything and everything macro. We have oil retesting the $100 levels. We have a variety of crazy, excuse the speed of shit going on. And let's hop straight into it. Let's, I guess, first off, make sure that technically we can hear you, Dave. Are you?
Can you hear me?
Yep, we are all good.
Okay, good.
Beautiful. So
let's just trying to get some power to my cell phone in the car, but it doesn't seem to be.
No problem at all. Let's begin with the elephant in the room, which is clearly oil, right? I mean, it's just dictating anything and everything, asset prices globally. So, I guess what's your take and where are we headed with this huge, crazy macro fluctuation?
Well, I mean, I'm older than you guys, so I was around in the 70s. I studied econ at Northwestern starting in 79. So having just come through, what was going on there. And, it was triggered by an oil shock, but we had a completely different macro situation. Debt to GDP was like in the 30s, not 130. Things were different. And at that time, the U.S. was completely reliant upon Middle Eastern energy. But today, the U.S. is a net exporter of oil. And yeah, we import a few 100,000 barrels a day, but that's not really the issue. The issue with oil is these global supply chains that we do rely upon. Robert, who is here, has done relentlessly points this out on X that, how much of even our weapons are manufactured from global supply chains. And people who might not have their vested interest to sell us those components. So there's a lot of cross currents going, but the world is still dependent upon oil for sure. And when prices go this far over production cost, and basically more or less double right now, give or take, you kind of know it's not a long-term thing, but you also know that until there's a resolution, this is going to stay. And so it really is about things, if you're investing, you have to ask yourself, how much volatility can you ride out when you don't really understand or know, because none of us do, what the actual state of the war is. I mean, I don't think I've ever seen anything quite like this, where we don't have any idea. And it's just, you're getting totally different reports from depending on who you listen to in terms of what's actually happening. So you have to understand also, this is a supply. This is not an oil supply issue. This is an oil transportation issue. That doesn't make it any less real, but it is different. And so there's a lot of cross currents here. So when people talk about stagflation, what they're saying is prices being driven up from supply chain at the same time as we're losing jobs because of AI. Well, AI is severely deflationary in the consumer effect. There are two major reasons why there should be inflation. One, monetary inflation. The more we go to war, the more we spend, the more money we print. And that is not just in the US, that's everywhere. All governments are printing. So that's inflation. At the same time, you have massive supply chain disruptions caused by wars in two places. That's a big deal. And the one people aren't talking about, but probably would be the biggest single driver in terms of where the pain actually is felt, is probably in the global food supply, because lack of fertilizer as we get into planting seasons, et cetera. So, there are a lot of cross currents, as you
said. So then let's start there. You said that this is clearly something that you haven't seen before. What are the similarities to what you have, noticed in the past, and that we can look at as whether it be specific data points to try and extrapolate certain probabilities as to how long this might take?
I mean, when you don't know what's going on, it is impossible to extrapolate. People like to humans are trained to look for similar things. That's why in Bitcoin we have the 4-year cycle, and everyone says, "Well, look, the chart looks the same as it did in 22." I mean, I can remember in 2009 people pulling out charts of the 1930s, right? We had just come through the GFC, and they were predicting 5 or 6 more years and another 50 to 70% drop in the S&P. That didn't work out too well. Instead, what ended up happening, as Tom Lee was the first one to predict it, which I saw in majors, was we went on a massively long, arguably longest bull run in stock market history. And the reason was because they were printing enormous amounts of money, quantitative easing, etc. And we're still in that regime, and they still have that toolkit, and it may do less than it ever done before in the real economy, but in asset prices, it will do its job. So that's a large part of the way I would frame almost everything. We don't know the timing, but I don't see any road other than an increase in what I'll call monetary debasement. Call it whatever you want, but they're going to do everything they can to prime the pump. And the real question is going to be: is he going to be able to get Kevin Warsh nominated? Through the Senate, and how does that actually end up working? So we'll see, because that's a very big deal. Because if Powell were going to be the head of the Federal Reserve for the next year, then I think that the fear is that we might even see a hike before the end of the year. We certainly won't see cuts. But I think with Kevin Warsh, or well, whatever, anyone that Trump is nominating, I strongly suspect we will see them. And so, weirdly, yesterday, no one, after the Fed meeting, no one was talking about that. But I think that's exactly what's going on. And lots of people were talking about the fact that Powell said, "Well, if he doesn't get confirmed, I'll stay on," which is interesting, from a political gamesmanship point of view.
Yeah, if you look at the 1 year, it's 10 basis points above the Fed funds for the first time since end of 2023. So, yeah, I was a critic of the cuts, right, with assets at all-time highs and inflation running at 3. And I think that a lot of the cuts we got were probably not the best idea. I mean, we got this PPI print a couple days ago that was just red hot, and that was before that was February, right, before everything happened with oil. But arguably in this situation, they should be cutting, if anything, because financial conditions are tightening so much. I mean, here in the US, we've had rates all across the curve go up like 30, 35 basis points. That's significant tightening. And you have oil and other commodities, natural gas to some degree as well, also, making large moves. All of that is a tax on an already weak consumer that you were referring to earlier. So, yeah, so shouldn't we be talking about rate? I know it sounds counterintuitive, but shouldn't we be looking forward and talking about cuts?
If you're asking me, I agree. I think that this is when you see inflation from a supply constraint perspective. What is most necessary is investment in supply chains, investment in manufacturing, investment across the board, and cuts are the only good way to get there. The question is, will lower interest rates actually produce excess consumer demand that shows up in inflation? I
Yeah, I
I don't
agree.
see how. I really don't see how at this point. I mean, yes,
Yeah.
at some point, maybe if they slash rates to zero immediately, but they're not going to do that.
Yeah, I wanted to actually just bring up something that I saw Lynn Alden respond to. Specifically, this Patrick DeHaan was talking about how high gas prices now are an incremental $500 million per day in cost. And I guess what Lynn was trying to point out in response to kind of what BitPain was talking about was that the global, or I guess the nature of oil prices going up are not necessarily something that applies only to one segment, because it's so broad based. It's not something that you can necessarily mitigate. It applies to the entire economy, specifically, including your middle class and your low class, not just,
Well, if anything, it disproportionately affects the working class.
Exactly.
They spend a larger percentage or share of their total income. Yeah.
Right. Plus, don't forget diesel and the
And diesel,
ability
yeah.
to move goods around, and the goods that are we're talking staples now. We're talking things that affect the average person. It's a very big deal, right?
So
You're not
I guess,
getting beef to Florida from without trucks.
yeah, no, 100%. So then infra, I guess that's what's moving. That's one of the biggest components moving some of those charts that maybe you want to share in terms of interest rates
Um,
in the US. And
yeah, so I would add to what Dave was mentioning about AI being a deflationary force. I would add private credit to that. Here, by the way, is Ari's the price of Ari's relative to the price of IGV, which is a software ETF. And this is the same if you do Blackstone. It's the same if you do Blue Owl, right? Like it is tracking 100% with IGV. And IGV, of course, that those software companies being affected by the deflationary force that Dave was mentioning. So, you have not only on the labor side, on the labor market, that deflationary force, but you also have, wealth destruction, which is deflationary. You also have a potential, credit event likelihood. So, yeah, if we're going to look at rates, I wanted to show this. So the 5-year break even, this is derived from the TIPS, which is a market instrument traded on the market. 5-year break evens are breaking out to almost the all-time high going back all the way to 2023. Right now, 2.66% is what the market is pricing in terms of the bond market, at least in terms of inflation. So you've had a notable move higher in break evens. We've gone from 2.4 to 2.66 in, just a matter of, I don't know, 2 weeks, whatever it's been. We could talk about gold later. Here is the UK 2-year bond yield, and it is vertical. This is pretty nuts. So this chart goes all the way back to the end of February when the conflict started. But if we look at just today, we're up by 26 basis points just today alone. I'll go the daily. Maybe it's more intuitive there, more clear. This is just absolutely wild. Now, they're going to be affected, not just the UK, but all of Europe is going to be affected to a larger degree than the US, due in part to what Dave was mentioning. The US is actually a net exporter, and we have ample, energy resources, but Europe does not, Asia does not. So they're going to be disproportionately.
Can I ask a question, Robert? Yeah.
Yeah.
So the UK is interesting because they have the North Sea producing oil, but my guess is that I don't think they have any refining capacity. So I think most of their refining capacity is the problem is that you can pump the oil, but if you can't refine it without getting it to and from the Middle East, you're toast. Is that what's going on here? Because I really haven't read I really haven't been following it this morning. I'm not going to lie.
Well, so for the UK, what's driving it today? We had a Bank of England meeting. We also had a European Central Bank meeting as well today. So pretty busy morning. But yeah, Bank of England, they kept rates steady, which was kind of what was priced in and what the market was expecting. But what is driving rates so much higher is they were pretty hawkish in terms of potential rate hikes into the future and they of course mentioned oil. So that's what's moving things today when it comes down to the breakdown of their sources of oil and refined products. I have no idea.
Okay, sorry. Anyway, sorry for bothering.
No, you're good. So yeah, they have seen here. We're looking at the 2-year, which is, probably the much better predictor of what the central bank is actually going to do, right? I would recommend to people if, we had a Fed meeting yesterday, there's all this talk about the Fed and this one interest rate that they set. I would just recommend to everyone, save yourself a lot of time and a lot of mental anguish and just look at the 2-year. The 2-year is going to tell you where the Fed is going. So here, of course, we're looking at Great Britain, 87 basis point increase since the start of the war. And that is, of course, due to the fact that we have had oil just absolutely rip. And Brent, we're seeing a divergence. So kind of to what Dave was pointing out there, we have a widening of this differential here between Brent, which is kind of the global benchmark for oil. Asia in Europe, right? That's their price, and then WTI, which is kind of the American price. Well, if you look at the difference between the two, normally you can see it trades about $2, $3, $4. We are up at 14, and that is the highest going all the way back to 2013. So 13 years. This will probably continue to blow out as the U.S. is, looking at things like export controls that was being floated earlier this morning. So, as countries try to shore up their own affairs, and we're going to be all right because we are a net exporter. As that occurs, we'll probably see this divergence widening, and it's compounded by the fact that you have Dixie moving significantly higher as well. So here I'll zoom in to since the start of the war, the Dixie has moved, notably higher versus the euro, versus the yen. Those currencies, those economies, those countries are going to be absolutely crushed by higher energy, because not only is it priced in dollars, but they rely on imports for their energy. So you're relying on importing energy. You need energy, right? You can't print energy. You can't go without it. You need it, whether it be oil, diesel, some of the more refined products, jet fuel, all of it. You need that. You can't run a tractor on U.S. Treasuries. So you have the issue of needing it, right? But then it's also priced in a currency that is strengthening. So we have seen a bit of the kind of safe haven bid and, the typical dynamics that we have seen over the past 5 decades. We've seen a bit of that return here with dollar strength. So, if you're Europe or Japan, not only is the price of oil ripping higher, but is ripping higher in a currency that you can't print. Right. And this kind of gets into dollar milkshake theory and all that. But yeah, they're really under a lot of pressure. And, for example, we know that it pressures their kind of overall economy because, again, you need energy. Here we're looking at the French current account, 12-month rolling average of the current account for France, inverted. So the higher this white line is going, the more of a current account deficit they are running. And then in red, we have WTI. And the correlation is pretty clear. There was some kind of craziness with 2020. But yeah, outside of that kind of, brief period of volatility, we can see that when oil moves higher, it pressures not just France, any country that relies on imported energy, their overall economy is going to be severely pressured. And when it's pressured, what that means is that they're not buying U.S. Treasuries and trade, right? Global capital flows are the other side of the trade, right? Everyone is talking about, well, the Strait of Hormuz is closed and global trade is shutting down, and all this is very important. But remember that the other side of that is global capital flows. So, if global trade starts to slow down, if Japan, for example, goes from a $400 billion current account surplus to a $10 billion current account surplus, they are buying $380 billion less of U.S. financial assets. So there's, the trade, which is definitely important, especially when it comes to energy, when it comes to food, like Dave was mentioning. But on the other side of that is global capital, which is also going to see, severe disruptions. So I think that's probably important to touch on with what's going on with oil.
Can I tee you up a little bit as well on Japan? So we also talk about the carry trade. What you just said is the primary impact. I read this morning that Japan gets 85% of their oil through the Straits of Hormuz. So
Yep.
They are by far the most impacted major economy, almost double China. And I don't think people realize that. So if you understand that, and you understand that we're at the part of the yen dollar range where the Bank of Japan typically tries to threaten traders and make them afraid they're going to get squeezed, we're already at that level, that things could get interesting given the amount of money that is borrowed in yen.
Yeah. So,
before you respond, can you maybe just expand on interesting, Dave? Because I feel like you have experience with this market. And when you say interesting, what do you like? How interesting, and what specifically are you alluding to?
If you think of it this way, if you borrowed yen when the yen weakens, it's good for you. When the yen strengthens, it's bad for you. if traders start lining up and saying, well, the Bank of Japan's not going to have the firepower to be able to do anything to us and the yen's going to weaken, then it could counterbalance because you'd be borrowing again to counterbalance those capital flows that Robert is talking about. If, on the other hand, the Bank of Japan says, screw you, we can't afford this to happen because of domestic inflation, then there is no counterbalance. And then what Robert was talking about becomes rather critical if it goes on for any length of time in terms of our long-term rates and in general assets that have relied upon borrowing against the yen. So I think that understanding how that will play out, game theory, that is really, does really matter. I'm sure you agree with that, Robert. So
Oh, totally. So like the situation that we have developing. So, oh man, I hate when TradingView does that. So what Dave was referring to, this yen carry trade, here we're looking at yen dollar because it's kind of more intuitive. And you can see that generally it was a good idea to go short the yen, to borrow in yen, especially when the interest rate was so low or even negative. And so that's what people did. They borrowed in yen because at one point when rates were negative, you were literally paid money to borrow in yen. That was the kind of embedded incentive. So a lot of people did. Then they immediately sold the yen and then bought dollars and then bought U.S. Treasuries, bought mortgage-backed securities, bought U.S. equities. And, U.S. equities, bonds, everything went up in dollar terms, but also the dollar went up versus the yen. So you were making money both directions. You had positive carry. And when the yen carry trade has blown up before, like here, it was when the Bank of Japan was kind of unexpectedly hawkish. Because remember that when we talk about what a central bank, their interest rate, what they're going to do with that, what that really refers to is the central bank setting the price of their currency. The interest rate is the price of money. So to defend a currency, you would raise the interest rate. That attracts more foreign capital into your bond market, into your currency. And that is how you defend your currency. So what we got recently, by the way, was I think it was overnight yesterday into today. We also had, I think, a Bank of Japan meeting. It's honestly, there's been so much going on. It's hard to keep up. But they were a bit hawkish, right? They indicated that they were open to, potentially continuing to hike rates. And so, yeah, like Dave mentioned, we got all the way up to that critical 160 on dollar yen, and then immediately we have been moving lower, so stronger yen. The problem here is, their country is pressured by higher oil prices. So with higher oil prices, generally the yen is going to weaken, but we're already kind of brushing up against that point that Dave was mentioning is, for domestic inflation concerns for Japan, this 160 level on dollar yen is already a level we know they want to avoid or intervene at. And so when you approach 160 and oil is probably continuing to head higher for the next couple weeks, you are really in a tough spot where you kind of have to pick what you're trying to save. And it's quite, I don't know how it's going to play out. I was thinking about going long the yen yesterday. I kind of wish I did, but yeah, I'm not sure how it plays out because that oil, that energy cost, that is a really, really strong force to try to go up against, I just don't see how the yen is going to strengthen without significant amount of intervention. And remember, the intervention meaning the Japanese central bank owns about 1.1 trillion of U.S. treasuries. They sell those U.S. treasuries, raise dollars, sell the dollar to buy the yen. That is how the intervention actually happens. Now, the only thing that I would say on the bullish side of the yen is they do have about 250 days worth of fuel, apparently. That's what I've heard. So maybe they're not as affected. But yeah, the longer this drags on, the more that their country is going, their overall economy and therefore their currency, the more it's going to be pressured. And they're already dealing with kind of higher inflation already. right? They were one of the few countries that actually had higher inflation than the US. Now it's been coming in, but just a couple months ago it was 3%. So there's a lot for them to try to balance, I guess you could say.
So I guess then the logical next question is: this is the central bank of Japan versus the market, right? And they're basically fighting each other to figure out whether or not the central bank is going to step in. What are the different? You mentioned two different scenarios that play out in terms of which one they choose. What are the different outcomes associated with each of those? If they let it rip through 160 versus if they continue to.
Yeah, they if they let it continue to weaken, which I kind of don't. If I had to guess, I don't think they would. If they allowed it to continue to weaken, you would just have higher inflation in Japan. If they intervened, they would be selling U.S. Treasuries to then sell the dollar to buy the yen to kind of prop up the yen. So yeah, it's just a question of like higher inflation or defending the currency. It's, and I think, I think that they're going to rate check, they're going to jawbone, they're going to do all the kind of non-intervention things they can do. But this is not a story of just Japan, right? This is any country that is reliant on energy imports is going to be in the same spot. Europe, we've already seen the euro weaken like 2.5% last I checked against the dollar. They are very reliant on energy imports priced in dollars, and their current account gets pressured, as we saw with the chart showing France. Their current account gets pressured immediately from higher oil price, and so yeah, I think that it's not just Japan. That is kind of the one that everyone thinks of or focuses on, but it's South Korea, it's Europe, almost entirely, all of Europe. So yeah, this is going to be a global issue that many different countries are going to have to face, and you kind of could potentially get into a situation where maybe dollar milkshake. I know it's been super beat up, that theory over the past 2 years, but we could be seeing kind of early dollar milkshake kind of stuff.
Yeah. I guess then the next question I had for both you and for Dave, and maybe specifically for Dave, is given he's got more experience with some of these similar type of events occurring over his career, is this something that could lead to a recession? I mean, is it as simple as oil is a late stage indicator? It crushes through 100 and sticks at 100, 110, 120 for a few months. Is that something that could cause a global recession? And is US, I'd imagine it's more insulated than the rest of the world. But
Well,
is that an outcome that's likely at this stage?
as I said, you have to know the answer to how long this continues. And we can game theory it out, but just understand that when it comes to recessions, pretty much the West, certainly the United States, cannot afford a recession in the sense for a very stupid reason. The budget deficit of $2 to $3 trillion would become $5 to $6 trillion because they just would lose all the tax receipts and the spending goes up. So it's very much the kind of thing they want to avoid. And how will they avoid it? They will avoid it by turning on the monetary spigots the same way they did during the pandemic, and for a similar reason, because in the pandemic it was about supply chain inflation. So I think that's the U.S. Now that happens if we don't get a resolution. Understand, there's an entire spectrum from here from really bad events to really good events, and we have no idea which way it's going to play out. And you may think but we don't. The really
Yeah.
bad event is the war drags on for years. Iran continues to have the military capacity. The Gulf states cry uncle. We take a Pyrrhic victory and say, well, okay, we got rid of a lot of people. We did this. They wanted a nuclear, whatever, but they still have the guns pointed at the rest of the world, and they still control the Straits of Hormuz, in which case you have a pretty bad situation for a lot of reasons. And in that situation, a global recession is almost inevitable because the price of oil will be, it won't be a one-off thing that's 2 or 3 weeks. You'll start seeing the December contracts move higher. more significantly as opposed to where they are today. That's the bad side of the scenario. On the other side, a Iran that goes from a caliphate, goes from a cleric dominated Iran back to a more Western, freer Iran would be a massive peace dividend to the region. It would be a massive, it would bring, they would be more worried. The problem then would be oil prices dropping too much, or to drop down the cost of production, which has its own set of problems. But that event would be incredibly good for the economy, give the Fed and all the other central banks room to maneuver. And it is literally the diametric opposite of the bad
Okay.
situation. Now,
So,
markets aren't pricing either of these in. Now, I don't know how you trade with confidence without knowing which outcome is going to happen. And so that's really the kind of point here. It's like markets are more or less trying to figure out, are we going to be where we are today, or is it going to get worse? I don't think anyone's looking at, is it going to get better? What you should be buying is volatility, because volatility in a lot of these products, particularly long term, I believe is underpriced. I think it's pretty low given that range of output. But what the heck do I know?
okay, so then if that's the case, then and again, I understand that there's obviously a wide variety of outcomes here. Surely there's some way we could at least put a certain timeline to say, hey, like if oil stays close to or above 100 for 3 months, like
It won't take 3 months.
Okay, so let's get into that, because that's what I think, Dave, you're saying the market's trying to price this in and it doesn't know. But is it 2 weeks? Is it a month? Is it 3 months? Like what is a rough estimate for, hey, this is continuing to create global shockwaves, and some of these countries' bond markets just can't withstand it anymore, and they need the energy, so they need to continue to bid it up, and it turns into this whole self-reinflating philosophy.
There's also hoarding, and there's also panic, right? Like when people talk about $200 oil and they're, oh, that's crazy, that could never happen. You have to remember there's an entire industry, CTAs, of trend followers, right? That like follow. This is what we saw with silver just a couple months ago. There is that speculation, right, that can drive prices kind of to la la land, higher than they maybe should be. And then you also have, panic and hoarding. And panic is not just what we're going to see down the street, right, at our local supermarket. Panic also on the nation state level. You're going to get panic from nation states. I mean, you already see kind of fuel shortages parts of Asia. Thailand and India are two examples I saw. So, once you start to include not only the actual, fundamentals, which we've had, this is the largest energy disruption that we have ever seen as a share of total, supply taken offline. This is the largest energy disruption we have ever seen. Jeff Curry was saying, that this is a 20 million barrel per day supply disruption. Well, if you go to COVID, that was a 20 million barrel per day demand disruption. And what did we see? We saw oil go to negative $35, right? So I think that there is a huge amount of complacency being priced in right now, or that is, there's not enough risk being priced in on a number of different levels. I think that the recession is basically all but baked in. I don't see this war ending anytime soon. I think it's all but baked in. If you look at what oil does going into every single NBER defined recession, even 2022, where we got 2 quarters negative GDP and a bear market, we had an energy shock going into that. It is very, very reliable, arguably more reliable than the yield curve inversion. So I think it's all but guaranteed. People need to start kind of looking through the initial inflationary impact and start looking to the demand destruction that's going to come on the other side, because this is bad. This is very bad.
So I want to pull on that thread a bit, because I think that's a good point. If you have a recession that is caused by demand destruction at the same time as inflation caused by a supply disruption that interest rates have literally no impact on, it informs policy. Right? It should do, unless you're dumb. Now, I think there's 24,000 people at the Federal Reserve that, frankly, if you had a bunch of monkeys throwing darts at dartboards, you would get about the same level of output. So, there's that. But, other than my utter disdain for the value of the Federal Reserve as an institution, which I think we will be better off without it. Uh, even the dumbasses that are sitting in that building who think they're brilliant because they have these pieces of paper that told them that they're smart will understand that if demand destruction is what's causing a recession, and that's going to impact employment. At the same time, the inputs to inflation is something they have no control over, that perhaps they might want to think about cutting interest rates and not say the kind of drivel that came out of Powell's mouth yesterday. And yes, I'm being very sarcastic, and yes, I'm talking down to them, but I know my IQ is literally higher than these people, so they can say whatever they want to say. Yes, I only have an undergraduate degree in economics, but the last 3 times in my life I've argued with economists and professors, I've been right. So this one's just obvious, and to me, it's mind-boggling that they don't understand the difference in the dynamics of what causes it. They just kind of look at a number, which is inflation, and say, okay, well, obviously we need to do X because this is what our kindergarten book tells us to do. But I do think, however, that people like Scott Bessent totally understand what I'm saying. I think Kevin Warsh totally understands what I'm saying. Frankly, I think a couple of the other candidates for Federal Reserve chair that did not get selected totally understand what I'm saying. So if you're investing, you're always investing for the future. You're discounting that. And so the real question is sanity going to reign or not? Because if the answer is not, then not only do you get a recession, but you're going to have a significant destruction in the wealth effect at the same time when assets sell off. And if, on the other hand, the answer is yes, then you're going to see the attempt to create an even bigger, wider gap in the K-shaped economy by making assets go up, in order to try to help drag the bottom end of the K up a little bit. And we can all talk about what that means, but that's the way I think it unfolds.
Yeah, well, 20 million COVID was 20 million barrel per day demand shock, negative demand shock. What we see today is 20 million barrel per day negative supply shock. And so, as Jeff Curry keeps trying to point out to people, it is literally just the inverse of that situation, right? And so when he was saying that yesterday, I decided to just pull that period of time, mirror it, right, put it on, and see what it would look like. You're talking like a 165 WTI price, because 20 million barrel per day supply. Oil, the price of oil, it is not elastic, right? And you also have speculation, you also have hoarding and panic, which again, we're already starting to see. So I think that in order for demand and supply to clear, right, with a 20 million barrel per day supply shock, and it's only getting worse by the day, right? Every day I spend hours tracking this stuff. Every day there's a report here, there of a new refinery, a new pipeline, something being hit, right? It is only ratcheting up. So that 20 million barrel per day is probably only going to get worse unless you get some kind of miracle. And I think it would require like a literal miracle. Everything is pointing to it getting worse. You're going to have, you need price to do some pretty wild moves in order to clear the market. And I think that, that part of the event is not nearly priced in yet. I mean, oil went negative, right? During 2020, when we're having this kind of mirror image, oil went negative, and not just negative by a little bit, but negative by a lot, by $34, $35. So yeah, I think people really aren't prepared for how bad this is going to get. Just to clear, right? You have to clear the market when there is that much of a supply demand imbalance. And the other issue that we have is this time around, when you have a 20 million barrel per day demand shock, print 5 trillion. That's what they did, right? They just printed 5 trillion. When you have a 20 million barrel per day supply shock, you can't print molecules. As Jeff Curry has been trying to tell people, you can't print oil, you can't print molecules. And a lot of these refineries that are being hit, there was a headline earlier today that the largest natural gas field in the world, that Qatar and Iran share, is going offline, and it might take 5 years. There might be force majeure for 5 years, right? You don't just you can print 5 trillion in a day, in an afternoon, right? Airdrop that to a bunch of people, boom, you resolved it. But when you have a 20 million barrel per day supply shock, And a lot of those, a lot of that, the oil and the capacity to produce more is kind of taken offline for at least a couple months, if not a couple years. I think that things could get like really bad. And it seems like the only people that are worried are the commodity guys. It seems they all understand kind of what we're walking into. And the equity guys are just like, yeah, buy Mag 7 and sell consumer staples. And, it's like, it's just bizarre to me.
Yeah, there's only one person on the, well, not one person, but the person who benefits the most from all of this is Putin, because and Europe is completely dependent. Europe basically is staring at the barrel of being completely dependent on Russian natural gas.
And we removed sanctions on Russian oil.
And why do you think we did that? It's because Europe is completely dependent on Russian natural gas and oil.
And to get the kind of global, this is the part that when Trump talks about, oh, well, we're a net exporter, so higher oil prices are beneficial for, you, the average American, or the US economy. Like, technically that's kind of sort of true, but the part he doesn't say is that if you look at GDP, oil and oil production's 1% of GDP. If you look at consumer spending, it's like 65%. Right. So, maybe that 1%, a literal 1% of the economy that is oil and natural gas, maybe they do benefit from higher oil, but who really benefits is countries like Russia, Norway. For every $10 price increase in the price of oil, Norway's GDP goes up by like 1.2%. It's crazy. Their geopolitical stuff, the calculations they're trying to make, are they trying to squeeze China, all that kind of stuff, I have no idea. People are starting to float some pretty kind of la la land 4D chess sort of proposals when it comes to the master plan behind all of this. But I just think that, things are already, I mean, this has already been going on 3 weeks. And, again, there's no, for anyone paying attention to the daily updates, right? This is not getting better. This is getting worse as time goes on. And so I think that we're just kind of sleepwalking. It feels very similar to January of 2020. I was following COVID before it was called COVID. It was just this kind of mysterious new virus in China, right? And there were like crazy videos of like dudes just dropping dead over in the street. Like there were apparently morgues being overwhelmed, and the cemetery, or the what are they called, the furnace where crematoriums. There was like, reports that, they're burning 10 times as many people as normal, all this crazy stuff. And I'm watching, I'm trying to read anything I can get about it, and everyone else was just like, no big deal, right? I was telling him, I was like, hey, this kind of seems like this is going to be a big deal. This is kind of bad, I think. Oh no, and then boom, like a month and a half later, it finally hit. It kind of feels a bit like that, to me at least. I'm not sure about you, Dave.
Well, I mean, I think I think it does, but I think what's happening is people remember, and everybody who kind of, if you waited until it became, and look, I was following some people who were calculating the R value of it in February, early February. I remember telling my wife, because we're lucky enough to have a beach house on Long Beach Island in New Jersey, when we were living in Manhattan. I told my wife, which we had it winterized, we always do, because we don't go there. I said, open the house. We're going to probably have to move there and get out of the city. But she thought I was a lunatic. But she did it. So we called the plumber. We got it done. We went down there not once, 2 weekends in a row. Second weekend of February and the third, we went to Costco and we loaded the house to the gills with everything we would do. So yes, we did not have a problem with toilet paper. Yes, we did not have a problem with bottled water. Yes, we did. We were ready.
It sounds like your wife may have thought that you're a lunatic, but at least you didn't need to go get toilet paper from.
Well, the net result of being prepared was that we basically spent the next year sitting in a house, looking out at the ocean, being able to ride bikes when it wasn't 20 degrees and freezing. But we had a pretty pleasant pandemic as it goes. And watching how things were, I learned how to cook. Whatever, it wasn't the worst thing in the world. Very first world problem, right? just being. But at the time, people thought I was nuts. My wife, she literally thought I was crazy, but I was so insistent, and she knows me well enough to know that I'm not generally insane. I'm generally pretty level-headed. So when I get like that, it's like, okay, the math is the math. And of course, as within a week of us leaving New York and moving back down, moving into the house on the shore, New York got closed, and it was literally closed, just bam. Now, why am I mentioning this? Because literally, if by the time that weekend that New York got closed, if that's when you started to sell financial assets, you were literally the worst trader in the human race, because the next weekend was when, yeah, you think you're up a little bit because markets start crashing, and then the Fed does what they do, the bazooka comes out. It was literally the buying opportunity of the century. So, and particularly for Bitcoin, which for those of us who care about that. And I think the market is kind of looking at this and saying, okay, wait a minute. Yeah, everything Robert says is true, but aren't they going to do something to help my asset prices? And so therefore they're not selling. And so you're seeing this immovable object and, up against this irresistible force. So just the expectation, it is what used to be called the Fed put on steroids. And I think that's what's happening. So yes, I agree with everything Robert said, but from an investment point of view, question is it too late to sell? Well, there's a lot of stocks that are still priced to perfection. Gold, basically, what happened today and yesterday is a very severe retracement. Considering that gold should be reacting to monetary debasement, and that is pretty much inevitably going to increase. The question is how much of it was excess? Now, personally, I've thought that the equilibrium price for gold this year was 5,000. And so falling to 5,000 doesn't surprise me. Falling a little below it doesn't surprise me. I would be very surprised to see it fall much further. And if, in fact, there's a big round of monetary debasement because of the disaster scenario that Robert is saying, expect it to go significantly higher again when the printing turns on. So, I mean, I guess we'll see, but I think that people are trying to anticipate. And that's always the trick with markets. Anytime you think something is obvious, it's usually the opposite. That's the whole buy the rumor, sell the news sort of deal. It's really a question of if you think something is obvious and it's a contrarian take, that's when you buy or sell with both feet, because then you got both.
Dave, but that's literally what you mentioned earlier on. And I'm looking at a tweet from Nick Bardia here that says Bitcoin lost its trend in Jan, stocks lost its trend in early March, gold lost its trend, quote unquote, today. Whether or not it bounces, we'll see. The only thing that technically hasn't blown up is volatility yet, right? And I mean, that's kind of what you were alluding to. Your hands and go, is that not true?
I mean, I would argue stocks started to really falter in late October. Okay. That was when dispersion really kind of started to pick. I mean, if you're just watching the S&P 500, then yeah, I guess you could make that claim. But I would argue it started, and again, goes to what Dave was mentioning earlier about AI. A lot of this stuff is well in motion when it comes to concerns about AI obsolescence. That all started in like late October, early November. And so yeah, I would say that there, if you look under the surface and look at the rotations that were occurring starting kind of in late October, I would argue that it kind of really goes back to then for stocks. And I would just point out with gold too, that like when real rates are moving higher, as we've seen about an 80 basis point move in the real rate over the past couple months, you're going to have gold start to stumble. Here goes back all the way to 1974. The 12-month rate of change of the gold price is a very, very tight inverse correlation with the real rate. So as what we were looking at earlier with rates and what's going on in the bond market, as that is occurring, you're going to definitely get pressure on gold. And we've also had DXY strengthen quite a bit. So that is going to pressure gold. But I agree with Dave that personally, I wrote that article, a month ago. I think that we're going to get a severe bout of kind of deflation, economic contraction, negative economic shock, growth shock. But I think that very quickly that would be the best buying opportunity for things like Bitcoin, because they will print so much, as Dave mentioned, and I've done the math multiple times, like a dozen different times. If we go into a normal recession, the deficit would go from 1.7, 1.8 trillion over the past 12 months It would go from that to like 5 trillion, right? That's like 15% of GDP. You would have private credit, which, is already kind of faltering. You would have private credit blowing up. Well, that's probably another 5 trillion. You'd have the mortgage market blowing up. That's probably 12, 13 trillion, right? So like, and if AI is continuing to cause, issues in the labor market, you might be even talking about UBI, right? And the Fed would have to backstop that. So I think that they're going to print more money. I mean, I think that we're getting one of the worst negative growth shocks that we've had since COVID. But I think that they're going to print even more money coming out of it.
And
So
remember,
I guess
every financial asset has a denominator. If the denominator gets impacted, even if the nominal value of that financial asset is lower, I mean, not the nominal value, even if the real value is lower, the nominal value can still be higher. And that's
And
something
Dave,
that,
what do you,
sorry,
go ahead.
no, you do.
I was just going to ask you, the point about the denominator, I think, is super important. Stocks going up in dollar terms doesn't really mean all that much if the dollar's getting debased to oblivion, right? This is the part that people miss. If you look at the Venezuelan stock market, the Lebanese stock market, right? Anyone going
stock
Turkish,
market as well. I mean, it's the
it
same
goes
thing.
straight up.
It's vertical
Yeah.
line.
Yeah. So, but if the currency is falling fast, so I think we're going to kind of enter that sort of territory, but not before, a very, very severe negative growth shock. And I would just ask Dave, kind of the irony, like trader market irony of this. Gold's all-time high was the last Fed meeting, not the one a couple days ago, the one before, where a reporter asked Jerome Powell, "Hey, aren't you worried about gold? Don't you think gold
Hmm.
might be trying to?" It was the top. That was the top in gold, which I just kind of think is a little funny. Like from looking backward, the narrative and whatnot. Like fine, top signal, bottom signal. Like to me, that's pretty interesting. But I'm still very bullish, like medium to long term. But you get as much DXY strength as we've gotten. You get a continued move higher in oil. You get growth concerns. Dollar always gets bid, pretty strong into those growth concerns. So yeah, I think that if you're holding gold, I would or Bitcoin, I would be prepared for significant volatility over the next quarter, maybe or two. But then it's gonna just like I'm building cash. I'm up to like 35% cash right now. And I'd like to get that higher. And I will be buying that dip because they will have to come in and print the money.
Well, I wonder about Bitcoin from a delinking perspective because it has its own idiosyncratic stuff going on. I also wonder if this administration and Kevin Warsh Fed is going to wait. So I don't know what happens. I would say this: when you look at the Dixie, you're talking about the reason the dollar goes higher is because it's the dog with the fewest fleas. There really is no other currency on the planet that isn't in massive debasement mode, except for the Swiss franc. And
Yeah.
if you noticed yesterday, the Swiss National Bank came out and said, we stand ready to do anything we can to devalue the franc, basically, to sell francs, if we have to, because they don't want it to strengthen. So it's really fascinating, and that's why gold is such an important proxy. And I don't think it's terribly surprising to see gold and silver, and gold in particular, being pushed down. I just think that the geopolitical war, uh, China wants gold and silver to go higher, and I think that it will. I think that this is just, it is what it is. This was, people forced selling, breaking a margin, people, etc. We've seen liquidation cascades in Bitcoin with the contract for differences market overseas. There was enormous leverage on the margin from in the gold and silver markets. It just was, and it got wiped out over the last 2 days.
Yeah.
And
Implied
I don't think that's
correlations
surprising.
are implied correlations are soaring right now.
Well, yeah, well, it always happens when there's this is why I think we're no one's sleepwalking anymore. I think this is much more like late February in the pandemic, not January, even though the prices may not be. But what you're seeing is recognition of just how serious the situation is. So I don't know. I think that we're probably a lot closer to a liquidity storm than you think, and it depends. There are going to be companies out there that there will be assets that may or may not recover. Now, look, I tend to think that whenever I hear something is not going to recover, that to me is a buy opportunity. Uh, things like Dubai real estate and the UAE, people are talking about that. All I'll say is if you had bought, lower Manhattan financial real estate in, the 2 months after 9/11, that was a generational wealth creation event. Uh, but back then you couldn't give away apartments down there, right? Because, oh my God, it's going to be horrible. It's never going to come back. So, with that caveat, but just watch the assets that are absolutely being destroyed.
Well, and Bitcoin's already been kind of pretty weak, right?
Bitcoin
like
is 40 to 50% below any rational version of intrinsic value at today's price. So it's already cheap. And we saw it, I think technically bottom at around at the 60-ish level. So this to me is just, we failed the 74. We're in a trading range. It happens to be coincident with the rest of the world doing what it's doing. But I think if you try to trade Bitcoin on, it will be a mistake. Bitcoin is actually one of those things where there's, there's no Iranian regime uh, effectively taking all their flared natural gas and mining Bitcoin with it and selling it into the market. I don't know what the price of Bitcoin would be today, but it would be a lot higher. I mean, everyone who looks at paper derivatives, which is a bullshit argument, says that's why Bitcoin is lower, they're wrong. They don't know what the hell they're talking about for a lot of reasons. But on the other hand, if you want to understand mining supply and selling pressure, well, yeah, that's very, very real. And that's, but one thing, if you were like, for example, in a Gulf state and you were an expat out and you had gold, you were taking 20-30% discounts to sell your gold. If you have Bitcoin, you could just take it with you, right?
or real estate,
dramatically easier. And
yeah,
that's not lost on people. Well, if you had real estate,
yeah,
it's
I
even
think
worse.
Yeah,
Even worse
and
than
apparently the used car market was also, people were just fire sailing all their Lambos. Yeah, no, I think that this, we've always talked about Bitcoin's kind of moment to shine. I think that this is, part of the outperform. I mean, we've outperformed the S&P 500 by like 16%. We've outperformed gold by like 18%. I haven't checked it today. It's probably even more. So like that degree of outperformance in 19 days, that is notable. And I think that it makes perfect intuitive sense, right? When you think about it as Dave laid out.
Yep. No, 100%. Guys, sorry to cut off. I know, just to be cognizant of time, it is 1:30, so we're going to have to unfortunately cut it there. It's probably good timing because it looks like Dave is frame swapping from one frame to another. So, Dave, thanks for hopping on. Infra, same to you. Everyone, thank you for watching. Have a fantastic rest of your Thursday afternoons. One quick shout out, though. Just to Infra, if you haven't checked out his YouTube channel, he is on at Economics Unmasked. So just go to YouTube, type in Economics Unmasked, and you can see more of his work there. He puts out some amazing content. So quick shout out to him. Otherwise, thanks everyone for watching and joining. Have a fantastic rest of your day.
See ya.